So today, we're going to pull back the curtain on the world of professional asset management. We're talking about the intense scientific discipline that's needed to manage huge amounts of money and what really separates the pros from the speculators. I mean, let's just start with a question that puts it all in perspective. In a world that is, fundamentally uncertain, how do you even begin to manage the world's pensions, savings, and investments? The stakes are just astronomical. And when I say astronomical, I mean $135 trillion. That's a recent tally of global assets under management. Just let that number sink in for a second. A number that big doesn't respond to gut feelings or hot tips. No way. It demands a system. And that whole system, it's built on one simple but powerful word: rigor. This isn't about getting lucky. It's not about throwing a dart at a board. It is all about having a scientific, repeatable, and verifiable process. And that is the fundamental difference between professional investing and just gambling. Now, you might be thinking, okay, is all this complexity really necessary? And, it's a fair question. But the data is in, and the answer is a huge, resounding yes. We have actual empirical proof that a structured, rigorous approach to finance just flat out gets better results. And check this out. This is the hard data I'm talking about. A massive review looking at 76 different controlled studies found that rigorous financial education has a clear positive effect. It boosts what people know by a statistically significant amount. That's what that 0.15 sigma means. But here's the kicker. It actually changes their behavior for the better. So yeah, rigor works. Okay, so what does this word rigor actually look like when you're a big institution? It's not some vague, fuzzy concept, not at all. It's a very specific blueprint. So let's break down the 3 core pillars that basically every professional process is built on. First, every single investment decision has to start with an explicit, testable idea. You can't just say, I think this will go up. Second, you need standardized procedures. This means everyone calculates things the exact same way every single time, no exceptions. And third, and honestly, this is the big one, you need empirical validation. You have to prove your idea actually works on data it has never, ever seen before. And this chart right here, it tells you everything you need to know about the industry's real priorities. This is the curriculum for the CFA designation, kind of the global gold standard for finance pros. You'd think the biggest chunk would be hardcore math, right? Nope, it's ethics and professional standards. The message couldn't be clearer. Ethical rigor comes first, before anything else. All right, now we get to the most critical part of this whole process: testing your ideas. This is where the science really happens. It's how professionals separate the strategies that are the real deal from the ones that just, look good on paper. Think about it like you're back in school. A simple backtest, where you just run your strategy on old data, that's like an open book test. You can keep tweaking and tweaking it until you get a perfect A+. But walk forward analysis? Oh, that's the final exam. It's closed book, high stakes, and it tests your strategy on fresh data it's never seen. There is absolutely no cheating. And the grade you get on that final exam is called your walk forward efficiency, or WFE for short. It's a brutally honest metric. It asks one simple question. Okay, all that amazing performance you found in the open book practice round, how much of it actually showed up in the real world? And look at how tough the grading is. If your strategy keeps more than 60% of its performance, great, it's robust. 50 to 60% is acceptable, but once you drop below that, you're in big trouble. And below 30%, it's an instant fail. Your strategy is rejected, period. And I want to linger on this for a second because it's so important. If a strategy can't pass this test, it's called a pure artifact. That means any performance you thought you found was basically a ghost in the machine. It was just random noise, with no real predictive power, or as they say in the industry, no real alpha. The standard is absolute. So what happens when you're not rigorous? Well, you fall into some pretty common and pretty fatal intellectual traps. These are the kinds of mistakes that even really smart people make if they're not careful. Let's look at the top 3 rookie mistakes that professionals are trained to spot and avoid. The first big error is confusing a piece of data with a validated fact. See, a number all by itself is just a claim. Saying the fund returned 8.3% is data. But a fact is saying the GIPS verified net return, after all fees were taken out, was 8.3%. GIPS is like a global accounting standard for performance. One statement is basically marketing, the other is proof. Next up is overfitting. And this is pretty much the cardinal sin of quant finance. It's when you obsessively tweak your models so it perfectly explains the past, which, ironically, makes it totally useless for the future. It's like memorizing the answers to last year's test. Sure, you'll ace that one test, but it doesn't mean you've actually learned anything. And the thing is, overfitting leaves behind really clear fingerprints. You'll see these amazing results on your historical data, like a Sharpe ratio, which is just a measure of risk-adjusted return, of 1.8. But then, the second it hits new data, that performance totally collapses, maybe down to 0.4. And you can guess what that means for the walk-forward efficiency score. Yeah, it's going to be in that dreaded sub-30% rejection zone. And the final rookie mistake? Forgetting that spreadsheets aren't the real world. The real world has friction and costs. A strategy might look like $1 million on paper, but can you actually place your trades in the real market without prices moving against you? And are you sure you found a unique edge, or are you just getting paid for taking on some common, well-known risk that anyone can take? Ignoring these real-world costs can absolutely destroy a strategy. Okay, I know what you're thinking. This sounds like a ton of work. And you're right, it is. But here's the twist. Rigor isn't just a burden or a chore. In today's financial world, it is the single most powerful competitive advantage you can possibly have. And here's why. First, it makes you stand out. The vast majority of managers just don't do this level of validation. Second, it builds resilience. When a market crisis hits, you're not panicking because you've already stress-tested your strategy for exactly that scenario. And finally, it gives you legitimacy. It's how you earn real trust from clients and from regulators. It's your proof. So at the end of the day, the new standard for being a professional in this field really just boils down to this simple philosophy. If you have an idea, you have to prove it works, you have to document how you did it, you have to validate it on new data, and you have to build it so someone else can come along and reproduce your results. And that leaves us with one final, pretty provocative question to chew on. The next time you hear about some amazing can't-miss investment strategy, just ask yourself this. If it can't be proven, documented, and validated, is it a real strategy, or is it just a really good story?